Hello, this is Sana and Mona Ali here from Property Twins. Today we are talking about refinancing your loan with the new 1% borrowing capacity buffer that has been released by the banks recently. We wanted to talk to you about if you are struggling with tightened borrowing capacity and would like to access better interest rates. So obviously this has been quite a big concern currently in the market. A lot of people have maxed out on their borrowing capacities. Lending has tightened significantly for most people. So if that's you, this video may be of interest to you. So, there's been about 12 interest rate rises that the RBA has put forward, and the banks have passed these on. And especially if you are with non-bank lenders, some non-bank lenders have increased interest rates by more than what the RBA has increased the cash rate by. So this has created actually mortgage prisoners. So you might be feeling quite stressed. We've heard from a number of clients who have felt under quite a bit of pressure, and obviously that means RBA has done its job. It's working through the economy, which should bring inflation down. But the thing is, being stuck with a mortgage and a high interest rate means that unless your income went up significantly or lending loosened up in future, as a borrower, you're unable to refinance your loan to access better interest rates.
I think this is also an issue because of the Australian Prudential Regulatory Authority's 3% buffer. So when you go to a bank, the banks actually add another 3% as required by APRA to assess your loans. And that is unfair on borrowers. And we often have clients who come to us and say, well, I've been able to make my repayments per standard and I'm paying significantly more interest rate. Why is it that I cannot refinance to a lower rate and still be able to maintain those repayments and in fact pay more of my loan because I've access to a better interest rate? And it doesn't make logical sense, but we understand the reasoning behind why APRA had put that in place, and that happened around 2015, and it has not changed ever since. It really reminds me of the times in 2017 and even 29 until 2019, when the lending was significantly tight for borrowers, partially because of interest rates and also because of the APRA 3% buffer. And in that situation, many of our clients had the exact same conversation, especially if they were investors, right? They had to purchase properties with non-bank lenders, and then eventually, when the cycle changed, refinance them back to bank lenders. And at that point, there was no choice. And there is more choices becoming available, right? The banks have been a lot more creative to enable people to refinance and access better rates.
So what is the solution if you are in those shoes where you feel that your interest rate is higher than what the market is offering, or if you believe that you could do a little bit better? Then you're stuck and you're unable to refinance and unable to move forward. So there might be some options available to you to be able to refinance. So in recent times, some banks have released a new policy which allows you to refinance your loan, where the bank will use like a 1% buffer on top of your interest rate rather than the standard 3% APRA buffer that's as per the regulations. So say hypothetically that your proposed interest rate with the new bank is 6%, then the bank will put in a 1% buffer. So they'll assess you on 7% rather than 6% plus the 3% buffer being 9%. So this has opened up a lot of opportunity for those who have obviously, who are unable to refinance with the 3% buffer. So this may potentially mean you can save on interest. There are a couple of lenders actually that have come to market for this, and there may be more potentially, but there's definitely opportunity now for you to be able to do something differently.
And you might be wondering, why these buffers, right? Just for context, the regulator wants to ensure that you're actually able to afford these repayments should interest rates rise, and it is for the protection of the borrowers. But unfortunately, it's become more of an enemy of the borrowers when rates have risen significantly, and they can actually get a better rate and do better with their finances.
And also, I guess it's like, is it really in their best interest to be stuck paying the higher rates? So obviously, whilst the regulations are in place to protect borrowers from overextending themselves, but having being assessed on like a 9% rate, like who knows what would happen in the future. But currently, it really isn't not in your best interest when you know that, with Bank A, you're paying a higher rate. They won't budge, they won't negotiate on your rate, and Bank B could potentially give you a better rate and your repayments would reduce. It would give you a bit more breathing room. So it's not really in your best interest. So whilst the buffer is in place to protect the borrower, I don't know if it's working the way it's meant to be working to protect you in the current climate.
And from an average person's point of view, right, it might seem like it's in the bank's interest for you to continue paying higher rates. But what borrowers often don't see is in the background, the banks have funding costs. And especially during the couple of difficult years we've had globally, RBA lent money to the bank at a certain interest rate and a significantly lower interest rate. And they want this to be paid back to the RBA, and therefore, in particular, non-bank lenders, their costs have risen significantly, and therefore bank lenders' costs have risen significantly, and they're requiring borrowers to pay for it, and someone has to pay for it. Going back to this reduced 1% buffer, for you to be able to access this flexibility to refinance your loan to a better rate, given you're already paying a higher rate, you deserve a better rate, you must meet specific bank criteria. Some of this may include, but it's not limited to, having a specific credit score, no arrears or hardship reported in the last 12 months, and lastly, loans having been existed for at least 12 months for you to be able to do that. And these are available for both principal and interest loans, owner-occupied loans, and they're also available for interest-only loans, which could be investment loans that you might have, and there's no point in paying a significantly higher interest rate.
That's right. So if any of this resonated with you, and if you feel that your borrowing capacity is tightened, or you're not sure if you are able to actually move forward and potentially access a better rate, maybe potentially tweak the structure of the loan so you could have a bit of a room there, and also then having a lower rate and paying off your loans faster, then please set up a time with Sana and myself. To do this, you can book a time in our diary. The team will pop in a link in the comment section so you can set up a time on meetme.so/property twins. That's meetme.so/property twins. Or alternatively, you can also send us a direct message on here or wherever you're joining from.
Thank you, guys. See ya.